All right, so again, good afternoon. My name is Dave, and I'm with the Compass Options Trading Room and Alert Service. It's a service I have I've had for I'm in my third year right now of doing this, and the trading room itself is unlike most trading rooms. I'm actually in the room on the air from market open to market close 5 days a week. You know, I'm not talking all the time because I'm looking for trades, but I do answer questions. The members in the room can post trades that they're interested in. We'll bring up the charts, we'll look at them, we'll discuss why it's a good trade or why it's a bad trade, or where's the support level, where's the resistance levels, and we talk about the strategies that we use. So there's a lot of education that goes on in there. There's also a Discord room that comes with that. So we have a couple of other professional traders in the Discord room. So there's a lot of information that's available to everybody that come in this service. And then we have the alert service, which I'll go over in just a minute. All right, so let's get started. Again, I have they call it the SPY super system. This is an intraday SPY trade that I do from time to time. That's based what's called the SPY super system by using the criteria that we find to determine when to take those trades. And then I have the alert service and the trading room. All right, so that's again, that's me. I'm Dave Wise. All right, first thing I have to do is the disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky. Keep that in mind. You should never trade with more money than you can afford to lose, because if you lose your bankroll, you can't trade anymore. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. All right. And by the way, if you have any questions beyond what I can answer, if you just put your name and number or your Skype username in the chat box or the question box, Rory from Right Line will call you back and answer any of those questions that you have relative to the services and the systems and things that I can't or don't answer during the webinar. This is just kind of a graphic of what the Compass system looks like. We'll talk about here. How we track institutional money. I'll get into that. That's the most important thing. And this is just kind of graphics of what that looks like. I run the Compass system on ThinkorSwim, but you don't have to trade on ThinkorSwim. This is what the graphic of what the alert service looks like. This is what the alert looks like when it comes on your phone. I send out the alerts and on these high probability trades, and typically you'll get them in about 30 seconds or so. I'm on the alert service, so I can watch my phone and make sure the alerts are coming through on a timely basis. But this is what you'll see. And again, it's great for folks who want to be taking trades and they don't want to be watching the market all the time. Now, before I get into too much detail here, I want to talk about a couple of things. Okay, John, thank you very much. I see your number there. Excellent, appreciate it. Market consists of a lot of retail traders. That's these little marbles. That's retail traders, such as myself and most likely everybody else in the room. We're retail traders, and it's important to understand that we as retail traders, we can't move the market. We can't create trends. We can't reverse trends. We can't do anything except when we're in the trades by ourselves. What you get is a lot of chaos and a lot of chop. The market's chopping around. There's chaos. There's no trend. It's very difficult to make money when you just got retail traders in there. Now, this big marble in the background, this is the institutions, and this is what moves the market. Institutions are, and probably know this, things like J.P. Morgan, Goldman Sachs, Wells Fargo, all the big investment banks, and all these investment banks, by the way, have things called algos. They have programs that they've been written that trade automatically. They're algos, and they trade off of specific criteria, specific setups they look for. There's a lot of different ones they use. Now, in addition to the investment banks, you have hedge funds, hundreds and hundreds of hedge funds. All of these folks have billions and billions of dollars to put into the market. Then you have pension funds, huge statewide pension funds. Again, billions and billions of dollars. And then you also have your mutual funds. Mutual funds are huge. Vanguard, T. Rowe Price, billions of dollars to invest in the market and trade in the market. And this is what they do. So this is the institutions. These are the folks that make a market direction. These are the people that create the trend, or the computers that create the trend and reverse trends. And this is what we need to know. We need to know when the institutions are in a trade and when they're not, right? Because we as retail traders are not going to take any money from the institutions. We're going to take our money from other retail traders who don't know as much as we do about what's going on. We know what the institutions are in there. When we're in the institutions, we're going to take our money from these folks. All right. I have some rules to trade by in the room. These are pretty simple rules. Trade the best, skip the rest. Sounds really simple. It's not. You've got to try to find the best trade and skip the rest of the trades. This is important. If you don't want to be trading stocks that may look good but don't have institutional involvement, they're going to end up being losers for you overall. We only want to take trades that give us the best likelihood of being profitable. And again, our objective is not to make trades. Our objective is to make money. And this is basically meant to create some patience in traders. Traders are very impatient for the most time. They like to be in the market all the time. But we don't want to make trades just to make trades. We only want to make trades to make money. So that's why I listed that, to kind of emphasize patience. So we as profitable traders, we need an edge. And our edges here at the compass room, the right line compass system, is we use the right line compass system. And I'll go over what this is. This is a system that lets us know when institutions are in a trade and when they're not in a trade. And then we also trade, this is very important as well, relative strength and relative weakness. Now, relative strength doesn't mean RSI. Relative strength is how is the stock that you're looking to trade, how is it trading relative to the S&P 500 or the SPY index? So if the SPY is moving sideways and up and the stock is moving down, then it's got relative weakness. If the S&P is moving sideways and down and your stock is going up and consistently on 5-minute candlesticks, then you've got relative strength. It adds a big edge to your trading to be able to do that. We also want to trade with a market trend if there is one. Sometimes the market's choppy, like it's been lately. It's difficult to trade with a market trend. Then we lean on our compass system for institutional trading and the strength of our stock. And another key thing here is to not to chase. This is meant to not to chase stocks. Buy at support and sell at resistance, or near support and near resistance. In other words, if a stock takes off and starts ripping up first thing in the morning, you don't want to be trying to chase into it. Sometimes it'll keep going, but most of the time it's going to turn around and come back to support and then bounce off of there. And once you've identified that, then you can get into the trend and follow it up as opposed to getting trapped at the top. And much easier to trade like that, much smaller drawdowns. All right, so this is just kind of an overview of the compass system. The compass system, it identifies the highest probability trade setups while sidestepping setups that look good but will fail more often than they succeed. Again, Compass does this by identifying when institutions are driving the move and when they're not, and this is really important, and I'll show you how it does it. And the Compass system analyzes complex trading data and displays the results in easily identifiable visual format. This is important because for new traders especially, or even people who have been trading a while, it's very difficult a lot of times to know whether institutions are in there or not. And if you were just trying to crunch the data yourself, it'd be very confusing. But this puts that information on a chart in color codes, which makes it easy even for new traders to find these trades. All right, so we'll get into that. And again, we get an edge over other retail traders because that's who we take money from. Our edges are we only take trades that are being driven by the institutions, as I've said, that have relative strength, which I've said, and trading in the direction of the overall market. If you can take a trade and you have all three of these things in your favor, it gives you a massive edge over everybody else. Again, our trades are going to be supported by institutional buying and selling. That's how it gives us an edge. They'll be outperforming the index, the SPY, and they're going to be moving in the direction of the overall market. Again, all these things is what gets us into high probability trade setups. What I want to do here is I want to look at recent price action. I'm gonna pull over some charts. I don't have them in here because I want to look at real-time charts. I'm going to go over two of them. And this is my TC2000. I use TC2000 as my charting platform. But this is TC2000. This is the S&P 500, the SPY, and this is a daily chart. Each one of these candles is a daily. And I want you to go back and look. This is November back here. All right. So this is where the markets turned and got bullish. And you notice You notice the trend here in the SPY. See how it's moving up through November, December, a little blip in January, but still bullish, 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 bullish. Now, I want you to look at some of the lines I've got on here. This white line is the 8 exponential moving average, and this orange line is the 15 exponential moving average. Those are levels that I use to determine whether to stay long the market or not, or get out of the market or go short the market. As long as they stay above that, then it's okay to stay in a long trade. The key lines here is this red line is the 50 simple moving average. This blue line is 100 simple moving average, and the purple line is the 200 simple moving average. These are very important lines because all the institutions rely on these. They use these, they trade off of these. All right, so this is the SPY. So you can see the movement in the SPY from November. Now let's look at what happened here. This was back a week ago Thursday, all right? This is the 4th of April, I guess about a month ago. And you see this big, huge bearish candle here. See this pink candle I've got here, this engulfing everything else? That was a warning sign that this upward trend in the market, which is starting to get a little bit choppy, was in trouble. And if you were in longs at this point in time, this was a good idea to say, okay, I'm gonna wait and see what the market's gonna do from here before I continue. Now we chopped around a little bit on the 8th because it bounced up the next day and everybody's breathing a sigh of relief. Okay, no problem, this didn't mean anything. And then it's still riding along the 8th, but then look what happened. Here we go. Now, when this market's coming down like this is the 50-day moving average right here. That's the first thing that would be support. So did it find support on it? It did right here. But look what happened the next day. It opened up here. Everybody was happy. It looks like we're going to go back up again, and we collapsed right through the 50-day moving average. So now we're kind of in no man's land here. Do you want to go short? Well, you could probably intraday short here, but I wouldn't be swinging short because I've got this 100-day moving average down here. So here comes the market coming down. So this warning sign was pretty telling. And now we've got these big pink candles coming down. And the reason these are pink, by the way, is in my TC2000, when a candlestick is bearish, it's obviously it's red, and when it's bullish, it's green. But if it's bearish and it's breaking out of compression, or the Bollinger Bands are expanding, I color it pink, and I color it blue if it's bullish and the Bollinger Bands are expanding. But so this is you can see this collapse. Now here's an interesting thing on the SPY. You see how it came down, and see how it got close to the 100-day moving average, but didn't touch it yet. All right, so that's something that I get concerned about because generally speaking, with institutions, they're going to wait for a support here at 100-day moving average. So are we going to come back and test it? I don't know. I don't have any idea, but I'm leery of it. So now we get close to it, and then we moved up again nicely and kind of chopped around. Now see, this trading environment right here is terrible for trading, day trading or swing trading, because it's nothing but chop. You're in basically this box. But the SPY moved up, see it get close to the 50-day moving average here, and then pulled right back again. And then we had a big, this is a inverted hammer, and this is a hammer. The SPY moved up through the 8, and then yesterday, we had a big day, a big gap up day, and notice we closed just above the 50-day moving average. This is a pretty important deal. We've got to know on Monday if we're going to hold this 50-day or not. If we fail this 50-day and start heading back down again, we're likely going to head back down and touch this 100-day at some point in time. So that's what I'm watching here, and that shows you the conditions that the market have to give you trading. This is not a good time to be taking a lot of trades or putting a lot of risk on. This is a good time to be putting a lot of trades on and taking a lot of risk. Now, one other thing I want to show you is the compass system in this same kind of an environment. Let me find it here. Oops. All right, so this is the compass system. This is the daily chart on the compass system right here. I'll just briefly cover some of these things, but these are the indicators that we use to tell us what the market's doing. Green and blue are bullish, red and yellow are bearish. The indicators that we've got here, this is a long-term trend. This is multi-time frame momentum. This is current time frame momentum on the current time frame, and this is money flow, and this is a derivative of money flow. Now you see how the colors keep changing back and forth here and just chop, and you see how this is chopping around. This is telling us that there really isn't anything in the market that we can lean on. We need multi-time frame and current time frame momentum to be matching, or blue and green, or red and yellow. They need to be one of those. You notice here we've got red on the multi-time frame and green on the current time frame. This is telling us we've got some current time frame bullishness, but longer time frame bearishness. So this is choppy. So this tells us that the trading is not that great. Now, as we were coming down here, you could see that when everything went pretty much red or yellow, except for the money flow, that it was pretty bearish. But again, I was looking at the overall market as far as support and resistance levels are concerned, and I didn't want to take anything too long. I was intraday trading some shorts here. But you can see the colors just changing back and forth. Now, let's go back to look. Remember we said back in November how the market was a good trend, was trending up, okay? Notice here, this is when the market turned and started to trend to the upside. You notice that all of the indicators have gone to green. Everything is green. This is telling us that the institutions are buying the market right now. Everything is here. So this tells us by looking at the compass system that institutions are in these trades on a daily basis. For swinging, this is a good time to swing because everything is green. And it's green or blue. So this is a good time to be taking intraday long trades, which it was. I mean, the market up nicely. You see how it continued on up, it continued on. Now here, as we come into the first part of January, we're getting a little bit of color changes. So you want to take off your longs and not be going short yet because you've got mixed colors. So this is where you get put much less risk on, take fewer trades, take quicker profits. And then we move into end of January and February, which actually was pretty good. We had a little bit of a blip right here, but overall the market was nice and bullish, and stayed fairly bullish. We got some current time frame switching back and forth, but everything else is staying green. And then we come in and see how nice and bullish this was during first part of March. And now things start to look bad. And now we've got all these colors changing back and forth. So this, I just wanted to show you how the compass system will let us know overall on a daily basis whether it's a good market for trading or not a good market for trading. All right, so those are the things that I use. For overall, I can also use them on 5 minutes. Like if I switch this over to a 5-minute chart, this is the compass system on a 5-minute chart from Friday. And you notice that you've got a couple of good times in here where things were green, and then they go switch back and forth. So a lot of mixed colors, not a good time for trading. We switch all the way out here, and here we are at the end of the day. You notice mixed colors, no good. All right, so that's how I use those TC2000 in the compass system to give me an overall market look. All right, so I have basic high probability trading setups. Let's talk about how I find these high probability trading setups. I basically run any stocks that I'm looking at through a funnel. It's not a physical funnel, it's a mental funnel. So what I'm looking for is I'm looking for daily chart and 5-minute charts to align. Anytime I take a trade, the daily chart, if I'm going long, the daily chart is going to be bullish. I'm not going to take a trade long if the daily chart is bearish, because it allows me it forces me to get out of the trade as soon as it turns against me. If I've got a good bullish chart on the daily basis, I can stay in the trade overnight through the rest of the day, whatever I want to do. I also want to trade with a market trend. If the market trend is bullish, I'm going to be good going long. Market bearish, I prefer to be short. Market's choppy, then I'm basically just going to focus on the individual stocks as far as the daily and 5-minute chart. Then I have to look at the compass indicators, and I make sure the compass indicators, if I'm going bullish, I want them aligned. I want to know the institutions are in the trade. If they're not in the trade, this negates that I'm not going to take the trade if the institutions aren't in it, because I'm just jumping in with a bunch of other retail traders who don't know, most of them don't know what they're doing. And then I'm looking at relative strength and relative weakness. I want to make sure the stock has got relative strength if I'm going long, and relative weakness if I'm going short. And then I look to see whether it's near support or resistance. Now, if it's not at near support or resistance, a lot of times I'll just pop an alert on my chart to let me know when it gets to that level, if it ever gets there. And that gives me a chance to get in trading. So this is the funnel method written out right here. Identify market trend for the day if there is one, and trade in that direction. The stock to be traded should have a daily and 5-minute chart aligned. This is really important. And the compass indicators must align in the direction of the trade. These two things right here, if you follow these two, just these two elements, most of your trades are going to work out pretty well. Not all of them, but most of them are going to work out pretty well. And then if you add relative strength and relative weakness, it even makes it better. Now, on the 5-minute chart, one of the things that we look at is the stock price needs to be above the volume weighted average price. I'll show you what that is. The VWAP for long and below the VWAP for short. This is important because the institutions use this as a support and resistance level. And then again, you want to enter near confirmed support for long and near resistance for short. And you obviously want to look at the daily chart and make sure there's no nearby support or resistance on the daily chart to limit your profitability. All right, and the key thing here is have patience. This may seem like a lot, but it's once you get used to actually doing these things, and this is what I do in the room, is go over all these elements. So somebody shows me a trade, I'll show them which element it's lacking, which is why we wouldn't want to take it right then. All right, so in the room and on the alert service, the strategies we use straight calls and puts, obviously, quite a lot. We trade mostly options. I do trade stocks occasionally, but only if the options aren't workable. So we trade straight calls and puts. We do debit spreads using weekly options expiration. This is something a lot of people don't do and don't even know the advantage of it. It's much better than trading debit spreads that go out 3 or 4 or 5 weeks. The ROI is much better. I use what's called time spreads over earnings. It's a calendar spread. It's a non-directional trade. I don't care which way the stock goes after earnings. All I'm trying to do is capture the volatility crush that occurs when an earning comes out. The premiums are jacked up on a stock when its earnings are coming up, because the market makers don't know which way the stock's going to go and how far it's going to go. So they increase the price on the options. It's called volatility. And when the earnings come out, that volatility crush comes out of there, and we take advantage of that by doing a time spread. And then I have another one called the weekly ATM strategy. This basically captures premium week after week by selling puts against a much longer dated put. It's basically a spread that I'm just selling weekly puts on to bring in premium every week. That's basically just taking advantage of time decay. And then we also do regular credit spreads to capture premium over a few weeks. If you're familiar with what a credit spread is, you're basically selling a put and then buying a put at a lower price. Then both expire at the same time. And you want the stock to stay above that put that you sold, and then you capture the premium as the time decay goes by. It's pretty simple. It's just selling time. And then I have the super system, which I touched on briefly. It's basically I'm looking at high probability trades where the compass system is telling me the institutions are buying, for example, the SPY. It's on the chart coming off a support level, and I've got market internals that tell me that it's a long. Right, so those are the strategies we use in the room. This is what the alert service is, Compass Alert Service. Who is the stock designed for? Well, it's designed for day trades and short-term swing trades. It's not an investment service. I'm just doing day trades and short-term swing trades. I'd say it's probably 40% day trades, 40% day trades, and the rest short-term swing trades. Short-term swing trades meaning overnight to as much as 2 weeks, sometimes 3 weeks, but generally speaking, a few days is pretty much max on that. Again, it's designed for traders who can't watch the market all day. And the real-time alerts on the highest probability trade setup. So when I find a trade that there's a high probability trade setup, I'm looking at it, I'm calling it out in the room, I'm sending the alert at the same time. So everybody's getting these on these high probability trade setups. Now I don't alert on every single trade. There's some reasons that I don't send them out on an alert. Basically, if the stock's moving too fast, or I'm only going to be in the trade for half an hour, I'm not going to alert on it. You don't have time. It's not fair to the alert service members. They don't have time to get in and get out. And I also typically don't alert on trades that I take after 3:30 in the afternoon. If I'm taking a trade like a 3:45, because it's going to come out and you're going to see it after 4 o'clock. And it's not fair. So I only trade on the ones that I feel are we're going to be able to stay in for a little bit of time, at least a few hours, and you're going to have time to react to it. And we only take the highest probability trades, and we do that by identifying institutional involvement. I keep harping on this: institutional involvement, market internals, and technical analysis. That's how I find the highest probability trade setups, which is how I spend most of my time. Okay, this is just a P&L. I can update this. This is from last fall, end of 2023. This is typically what we usually see for results over a quarter or so. And that's based on $2,000 a trade. We put $2,000 into each trade that we take. That's pretty much, and I'm going to show you some results from that. All right, so this is the results. I'm going to just start with September. I don't want to go back months after month. This was the trades we took in September. Now, the reason I show this is obviously I want to show we have some losses. But I also want to show you what the normal percentage gains are that you're going to see. A lot of people they get emails or they get on webinars and they're being told that they're going to make 200, 300, 400, 5%, 500% of the trade. All right. Well, you can do it every now and then, but to be consistently profitable and you try to do that, you're going to be a loser. It's not a winning strategy. This is what we do. We get 23%, 43%, 16%, 32%. This is the kind of percentages you're going to see. And a lot of these percentages are going to depend on what the market's doing. How long can we stay in the trade? Because if it's a choppy market, we're going to take profits more quickly. If it's a trending market, we can stay in the trade a little bit longer. Now I'm using $2,000 as a trade. Listen, when I'm taking trades, a lot of times I'm going in with 40 contracts and then taking off 10 and taking off 10, but I can't reflect something like that in here. So this is what we did in September. You can see we had 25 wins and 2 losses, 92% win rate. This is about as high as I can get. 92 is normally my win rate's between about 85 and 88, 89%, but we had 92% in September. So 2,000 invested in each trade, created 7788. And September was a very difficult month for trading, as I mentioned here. I wanted to point that out because this was really good results for September. This was October, overall 24 and 4, so 86% win rate. That's pretty normal. And again, 2,000 invested in each trade, created a profit of 4480. And I just use this as obviously this is just a criteria that I use just to have something to measure by. Obviously, you could be doing 500, you could be doing 10,000. It doesn't really matter. And the amount you put in each trade actually should be changed based on the market conditions. Trending bullish markets, trending bearish markets, you can put more into a trade. Choppy markets like we're in right now, you should be putting less into a trade. So this was October. Again, you can see the percentages staying about the same. We had some losses. We have losses every month, pretty much. We've had a couple of months with no losses, but we're going to have more losses every month. And so again, you can see the percentage wins, 32, 23, 33. It's really all in the 20s, 30s, 40s, and a break even here. But this is what you see, but this is the end result. What really matters more than anything, besides the win rate here, is how much money you make. November trades here. And again, see the percentages look the same. 21 wins, 4 losses, 84% win rate. But we netted 5160. Notice we had 25 trades there. Here we had 29 trades, but we made more money on this one, even though our win rate was lower. And that's because, as remember I mentioned, November the market was trending up, so we could stay in trades a little bit longer. So we had more profitability off of November than we did in October. But obviously, it was still good results here. Here's December. Very few trades in December. Christmas time, New Year's coming up. A lot of traders not there. Choppy market. Didn't trade a lot. Again, 14 wins, 2 losses, 87.5% win rate. Netted only 3115. I say only. That's pretty good actually. But for 2,000 in a trade with this few trades, that's pretty good. Had a couple of losers, but again, you can see the consistency of a nice win in Microsoft at 63%. Another nice win in Microsoft at 31%. We've traded Microsoft a couple times that month. January trades. This was a nice month. 20 wins, 2 losses, 90% win rate. 2,000 invested, netted 7505. We had Gilead right here at the end with we had to get out. That was an FDA announcement that killed the stock. Not much you could do about it. But again, you can see the consistency here. And you can see time spread, debit spread, credit spread. We get some of each. We trade the strategy that we feel is best for the market that we're trading in. Right? But again, consistency. Mara was a nice 65% win. But again, you can see 20s, 30, 40% is what we get a lot of. RCL was pretty nice, 50%. And his February, this was a good month. We had 24 and 2, 92% win rate. This was a big month though, 11, 7, 45, and it was a nice trending month. We could stay in the trades longer. we can push our profit targets up a little bit. So 24.2 for 92%. Now I broke out the alerted trades here just to show for anybody who's interested in the alert service. You notice we had 22 trades here, 20 wins, 2 losses, 24 wins, 2 losses. So we actually had 4 less trades in the alert service than we had in the room. But again, 69.30 profit was pretty nice on the alert service. And again, you can see the percentages, again, a couple of losses, but again, the percentage gains are pretty consistent across the board all the time. So I kind of not going to do every single month. I haven't even done the March, April, May ones yet, but for the first quarter, January, February, March of 2024, so this was the first 3 months, trading room, we had 65 wins, 11 losses in the room, 86% win rate. That's pretty normal. 18,000, a little over 18,000 in profits at $2,000 a trade, if you put 2,000 in each trade. The alert service, 41 wins, 6 losses, 87% win rate. That's about 47 trades in 3 months. So what, 15 trades a month, maybe, something like that. And 87% win rate, 12,224. So that's the first quarter. I did recap 2023. This was what we did in all of 2023. And again, using 2,000 per trade. If you invested 2,000 in each trade taken in the Compass Options room, it produced a profit of a little over $60,000. If you started with an accounts balance of 50,000, I'm just using this as an arbitrary number. When you started, each trade would have used 4% of your account balance, but the percentage of the account balance being used in each trade got lower and lower as the account grew. And we produced 120% return on the initial 50,000 account balance, growing it to 110,000 at the year end. This just kind of shows you how we did. 2022 was very, very similar to that, pretty much the same percentage gain. And again, at the end of the year, of course, if you were putting 2,000 into a trade, the money you put into the trade was less than 2% of the final account balance. So it just kind of recaps what was going on. I did put some of the April trades. I haven't finished April yet. We had a couple of losses toward the end of April, but I haven't categorized them yet. But this was through the first half of the month. 9 wins, 1 loss. So 47.40. I think at the end of the month we were actually only up about 3,500 or something, but I'm just guessing right now. But this was the April trades, 9 and 1, and the alerted service was 5 and 0 for 2,932 weeks. So that kind of gives you an overview of what the system produces. It's nice to see some 2024 Q1 trades. Yeah, that you saw them. And again, a lot of it has to do with the way the market goes. I've been trading. This is my 3rd year, so 12, 24, and another 5, 29 months. I've had 2 losing months in there. One of them was a loss of $249, and one of them was a loss of $1,150, I think, if you put 2,000 into each trade. So 29 months, 2 losers, very small losers, and you're going to have some of those. I mean, you have some losers. I try to be upfront about all this stuff. Not every trade is going to be a winner. All right, so when you get the alert service, if you sign up for the alert service, what you're going to get is you're going to get the stock symbol, obviously, the option strike price, the expiration date, and the price to pay for the option. And this could be a range. This could be a few. This could be $1 to $1.05 or $1 to $1.10, something like that. Give you a little bit of range. Now, I will tell you, if you get an alert and the stock's moved, instead of $1, it's going for $1.30. My advice is not to chase it, to put the order in at the original price. And a lot of times, and most of the time, the market will pull back, the stock will pull back, and you'll still get filled at the price that we put in there. In other words, don't be chasing them up. It's because it may go to $1.60, and you're in at $1.30, $1.40, and I'm exiting at $1.60. Taking 60% gain on the thing. So that's what I would mention. Now, typically when I send out the alerts, I send out the order to buy on an individual one from the order to sell. You get an alert to set it to buy it, and then alert to sell it. Sometimes I'll put the alert on both prices on the same alert, the initial alert, but not normally. And it's important to understand, when you get the alert to sell, make sure you set the trade up as good till canceled, GTC. You want the trade to be good till canceled, so it's closed as soon as the profit targets are reached, even if you're not on your machine, or you're away and the stock gaps up first thing in the morning, and you can get filled. If you don't have that in there working, you may miss it. All right. All right, so I just kind of want to go over how we achieve these kind of results. We were able to identify when institutions are driving a trade, and I look when market internals are heavily bullish or bearish. This means a lot more trades, stocks being traded up on volume than stocks moving down on volume. But I look at that as well. And we only take trades when both of these are in our favor. It's not 100% true. I'll take trades when the institutions are in if the market internals are neutral. As long as they're not against the direction I'm going in, I'll take the trade if the institutions are in there. So we're allowing the institutions to drive the trade for us. And this is how we identify when institutions are creating a trend. Some people want to always curious about that. Arthur, so alert, you say just stick with the received entry price, do not adjust. Yeah, that would be my advice, to stay with the original price. No, if you want to, if it's depending on the option price, if the option is $1 to $1.05 and it goes to $1.10, you can do it at $1.10, but don't go to $1.25 or $1.30 or something. So yeah, that's what you want to do. Now, how do we find these institutional? How does the Compass system find these institutional trades? Well, it's looking at what's called a triple screen assessment. Now, what's a triple screen assessment? It's called, some people know it as a fractal. Some people know it as a multiple time frames. This is looking at multiple time frames. It's looking at three things. It's looking at momentum, and I showed you those. It's looking at trend, and it's looking at money flow. Now it's looking at momentum across multiple time frames. It's looking at trend across multiple time frames, and it's looking at money flow or derivative of money flow. When all of these are lined up across multiple time frames, when you have multiple time frame momentum and current time frame momentum all moving up, and multiple time frame trend all moving up, in other words, the institutions are driving the trend momentum up, the trend is up. Just having these two here aligned tells you that the likelihood of an institution is moving that trade is hugely percentage-wise. 96, 97%. It's the likelihood is these trades are being done by institutions. So that's how the Compass system identifies these. And this is just, before we get into the options part, I just want to show you, this is the Compass system. I showed you a little bit of it before. This is a trade we took, but I'm really just interested in showing you what's happening. This is a 5-minute chart on Tesla. It's pretty old, but I want to show you how we identify this. You see, everything's green here. This is a multi-time frame trend. This is a multi-time frame momentum. This is the current time frame momentum. These two are very critical, and everything is green here. So you can see that the institutions on this 5-minute chart are buying the heck out of this Tesla. Now, it was also bullish on the daily chart. But see, we got in right here. You see with this pop out of the box, the Compass system generates this little pink arrow, which is a pop out of the box, which tells you that it's breaking compression. And it's coming right off of this little thin green line, which is a 15 EMA. So I know it's coming off support. So this is the kind of trade that we took. And this is what the Compass system is telling us. The institutions are in there. The lineup is nice. It's coming off support. Everything is in our favor here. And so that's what the Compass system looks like. And we'll get into some more of those charts a little bit later on. John, do I tend to go all in on each trade, or do I hold some back to average down? Well, I'd be honest with you. I usually take the whole position that I'm planning on taking. Let's say I want to take 20 options, all right? And I take 20 options on when I go into it. Now I'm typically not going to average down. I have averaged down in the past, but typically if it starts to work, I'm much more likely to add on the way up than on the way down. If it looks pretty bullish, I'll add maybe 5 more contracts or something. Now if I'm in the stock for a couple of days or 3 days and it pulls back to support and then bounces off the support and I'm red on the trade, but I still like the trade, then yeah, I'll add some more contracts of that. But I typically don't add. I do never average down unless I've got a reason to do that technically, which means the stock is pulled back to support and bounced to the upside. If I'm going long and it's back into the trend again, then I'll get into it and add to the position. All right. So I want to talk about options. And options are, a lot of people think options are the same as stocks. They're not. It's completely different. So let's talk about options. So this is, I first of all just kind of want to show basic stuff. This is a Bristol Myers. This is what's called an option chain. This is what you look for when you're trading options. This I did back in March, but this is Bristol Myers, and this is your option chain. Now, over here on the option chain, these are your calls. Calls are always on the left, puts are on the right. Right? So here's the information. This is the strike price. This is what strike price we're looking for here. Now it was trading at 53.79, so about 54 is the at the money or closest to the money strike we had. So this would be the strike price if you were looking to take an option at $54. And over here we've got the bid price. This is what people are willing to buy the option for, and this is the sell or the ask price. This is what people are asking for, what they want to sell it for. So this is a bid and ask. So this is your bid ask spread. So when you're talking about spreads, if this is really wide, it's much more difficult to get filled at midpoint. You're not going to be able to buy this at 61 cents, but you're going to probably try to get in for 63 or 64 cents, somewhere in the middle, right? So that's your bid, that's your ask. Same thing on the call side. This is your bid, this is your ask. This number we got here in the middle, this is the delta. Now the delta tells you, we'll go over that. I'll tell it briefly. The delta tells you how much the option price moves in relationship to the stock price move. So if a stock goes up $1, if I've got a 52 delta here, then it's going to move 52 cents. The option is going to move, what, 52 cents for every dollar the stock moves. And that's right at the money at 54. If you notice that if you take the delta on the puts and the delta at the calls, they add up to 100. They're always going to add up to 100. All right, here's 71 on the 53s, 71 delta, 29 delta, adds up to 100. This tells you that if you're in the money, see a 53 call is in the money because the stock is higher than that, then the delta is higher, which means the more in the money you go on the options, the more that option price is going to move relative to the stock price. All right, so that's the option chain. Those are the things you need to know. This is an option chain, the same option chain. I'm just looking at one I've added here is one other column. Everything else is the same. Here's 54. See, we still got 61, 66, 52 delta. But what I added here was OI vol. This is the open interest and the volume. Open interest is the number of contracts that are already active in Bristol Myers at this particular strike price. So if we're looking at the 54 strike price, we've got 643. This is the actual number of contracts. That's the volume, and the 1,004 is the open interest. So there's 1,004 when the day opened. There was 1,004 contracts open on Bristol Myers. That somebody had either bought or sold 1,004 contracts, and this could be over a long. It could have been a month ago, but it's always added in. Now the current volume that's coming through here, the 643. This is how many options have traded today. Option contract traded today. That is not included in the 1,004. When the day ends, all of the stuff that was sold will be reduced, and all the stuff that's still active will be added in. So you'll have a new open interest at the end of each day, but it does not include the current volume. So if this went up to 700, this is not going to move. It's going to stay at 1,004. So it's good to know that because it tells you how much liquidity there is in the option. The more liquidity there is, the more open interest there is, the easier it is to get it in and out of trade. All right, so that's your option chain. Let me just take a quick sip of water here. Now, this may seem a little bit long and lengthy, but for anybody who wants to learn about options, this is some critical information. Okay, so we're going to talk about, this is basically the subject matter we're going to cover quickly here. What are options? What makes up the option premium? What's intrinsic versus extrinsic? This is important. We're going to briefly talk about some of the Greeks, not all of them, just the ones that I use. Strike price and expiration date, volume, open interest, and primary option trades. I'll go over the particular strategies we use. Options gives you a myriad of strategies to use. And we're also going to go over bullish option strategies, bearish option strategies, neutral option strategies, and the setups. This is important. If if you like a stock long and you want to do options, you'll have several strategies to choose from. So you want to be able to know that. Okay, let's see, I got a question here. And let's see, your prior session last Saturday, advice to take in the money calls with deltas of 55 to 75 has been good for you. I tend to go expirations 4 to 6 weeks out. You advise 3 to 4, I believe, with deltas. And what I typically recommend is deltas of 65 to 75. And where you're going to go out is you want to just be further out than how long you expect to hold the trade. I usually do 3 to 4 weeks. You do 4 to 6. It's fine. All you end up doing in 4 to 6 is you give yourself more time, and you also have more time for it to recover, but it costs you a little bit more. But your criteria is good. 65 to 75 delta though. Get in the money around 75. That's a sweet spot for not paying too much and getting a good ROI. Okay, so let's talk about options a little bit here. Now you've got puts and you've got calls, and they come with rights and obligations. So this is important to know. When you can either buy a put or a call, or you can sell a put or a call. Completely different obligations and rights. When you buy a call or a put, you're long a call or long a put. This gives you the right to buy the stock at the level at the strike price that you bought the call or the put at. All right, it gives you the right to do that, but you don't have any obligation to do that. You can just, most people just sell the option when it gets profitable, but you do have the right to buy the stock at that price. When you sell a put or sell a call, you're short a call or a put. All right, this is a whole different situation. When you sell, if you sell a put, for example, on a Microsoft at $95 and the stock falls below $95, well, I'm sorry, stays above $95 when you're selling a put. In other words, you're selling a put. You don't want the stock, excuse me, to go below the price. So if you sell it at 95 and it drops down to 90, all right, then you're going to have the obligation to sell somebody that stock at $95, even though it's only trading at 90. You are obligated to do that. That's what's called an assignment, and you'll get assigned. And that same thing works on puts and calls. So just be aware of that. This puts you in a much more precarious position, which is why if you're selling uncovered puts or calls, in other words, if you're selling a naked put or a naked call that's not in a spread, you're adding a lot of risk just because you can get assigned to stock at a much different price than what it's selling at. And I would obviously suggest never selling naked calls ever. Naked puts are okay if you want to own the stock at a certain level. If you want to own Microsoft at 95 and it's trading at 100, you can sell a 95 put, and if it drops down to 90, you're going to get it at 95. So you're being assigned to stock, but you wanted to own it at 95. But if you sell calls, and let's say you sell Microsoft, you sell a call of Microsoft at $100, and Microsoft all of a sudden has a tremendous report, or they buy out some company, and Microsoft shoots up to $210, and you sold the call at 100. You're on the hook for $110 difference per share, because you're going to get sold the stock. You're going to be assigned the stock at 100, and you have to buy it back for $210 to cover it. Never sell naked calls. All right, so buying a call is a long call, it's bullish. Selling a call, a short call, is bearish. Same thing with puts. Buying a put is bearish, selling a put is bullish. In other words, if you're buying a put, you're expecting the market to go down. If you're buying a call, you're expecting the market to go up. Right, so those are the kind of the basics of that stuff. So what makes up an option premium price? All right, well, options can be at the money, ATM, ITM, in the money or out of the money. And this is important because when we looked at Bristol Myers, for example, it was trading at about 54. 54 would be at the money. In the money would be anything below 54, 53, 52, 51. If you had an in the money call at 51, it's going to cost you more because it has some value in it because the stock is in the money. Out of the money is if Microsoft's trading at 100 and you bought a $105 call, then that's an out of the money call. Microsoft hasn't got there yet. It's got to go up $5 to get to your strike price. I never buy out of the money puts or calls, never. And we'll talk about why in a minute, but I never buy, everything I take is in the money. There is exceptions occasionally, but they're very rare. But you don't want to be taking out of the money calls. People love them because they're cheap. They think if I'm buying a $105 call on Microsoft and this thing goes to 110, I'm going to clean up. That option is going to go up crazy because it's so cheap right now. I'm buying it for 50 cents, and it goes to 100 and it goes to 110. The thing's going to be worth $5 and $6, and I only paid 50 cents for it. Sounds great. Doesn't work. Most of these things close out of the money. Okay. All right, so let me just cover here what makes up an option premium price. So you got to when you buy an option, it's going to have a specific price. What makes up the price? Well, it's going to be made up of the stock price, obviously. Let's just take Microsoft at $100, for example. So Microsoft's trading at 100, so that's going to be part of your option. Then you have what's called intrinsic value. Intrinsic value is how much value is in your option. That's also part of the strike price.
All right, come on.
Yes, my wife taking the dog out for a walk. The intrinsic value is if you buy a Microsoft call, a $95 call, and the stock's trading at 100, so that call is going to be worth at least $5 because you're in the money on it. In other words, it's a $95 call and the stock's at 100. It's got $5 worth of intrinsic value. All right, that's important because that's based on the stock price. That's not going to be impacted by time decay or volatility. Well, it could be by volatility a little bit, but it's always going to be a value based on the stock price. So if you buy a $95 call, Microsoft's at 100 and it goes to 101. This $95 call that you paid for is going to go up by probably about 75 or 80 cents. All right. Now, implied volatility is also in the option price. So let's say the $95 call from Microsoft in the stock trading at 100. Let's say the $95 call costs you $6.25. All right, so you've got $5 of intrinsic value, but you're paying an extra $1.25 above intrinsic value. That includes implied volatility and time decay. Those two things are what make the option price worth more than what the actual intrinsic value is. These are the things that can be impacted by time decay and volatility changes. That portion of that premium. So if you paid $6.25 for it, and you got $5 of intrinsic value, the $1.25 is what can be going to be impacted by implied volatility and time decay. So the more intrinsic value you've got in your option, the better off you are, because you get less of that premium being impacted by time decay and implied volatility changes. Okay, and this is just intrinsic value versus extrinsic. Intrinsic value and intrinsic value is what I just talked about. A $50 option on a stock trading at 55 has an intrinsic value of 5. Right? If you bought a $60 or a 55 at a $60 call on a stock trading at 55, that would be all extrinsic value. You've got no intrinsic value in it at all because it's out of the money. So extrinsic value is the option value, what you paid for the option, minus the intrinsic value. All right. So if you paid $6.25 for that Microsoft we were talking about, you subtract out the intrinsic value, which was $5, then you get $1.25 of extrinsic value. That's what extrinsic value is. If the option strike price is out of the money, the entire option price is made up of implied volatility and time decay, which is why you said you should never take out of the money calls or out of the money puts, because every dime you put into that option is being impacted by time decay and implied volatility. So if the stock goes sideways for 3 days, you're getting crushed. The stock goes sideways in the money call, it has a much smaller impact on the trade. And again, also important is the volume of options traded at the strike price and expiration date. We talked about that, the open interest and the how many contracts they are, because it talks about the how much liquidity you've got to trade that. All right, we'll cover the Greeks here. I'm not going to spend a lot of time on Greeks, but these are the three that are important. Delta, we talked about delta. How much the option price moves in relation to the stock price. Stock moves $1, a delta of 50 means the option moves 50 cents. Again, I told you I usually take 65 to 75 deltas on my calls and puts. So my option is going to move 65 to 75 cents for every dollar the stock moves. Now, as the stock moves up, you've got more intrinsic value in your stock. Your delta is going to go up. So when I start out with a 65 to 75 delta, and the stock moves up, it could go up to 80, 85. And so it's going to, as it moves up, the option is going to move up even faster. Theta is time decay. This is critical. This is the decrease in the value of the option price as the expiration date approaches. So if you're out 4 weeks on an option, the time decay is fairly slow when you first start. It doesn't time decay very quickly because you still get quite a bit of time to expiration. When you get into the last week of an option, we've only got a week to go to expiration. The time decay is going to be really rapid because the amount of time that the stock has to move up further into the money or into the money, if you're out of the money, the amount of time that it's got to get there is much, much less. So the time decay strips more and more premium away from the stock. And this, by the way, is why I use weekly debit spreads on the trades that I take, because with a debit spread, I've got a short put or a short call, and then the time decay rips the premium out of those that I sold on that debit spread. But I have a video on that. So, and the last thing is gamma, and the gamma is the rate of change in delta. All right, so delta obviously is going to change as the stock price moves. But if you have a high gamma, that means the option price can change dramatically with only a small price in the stock. And I want to kind of cite an example of that. Do I screen on gamma when it's delta is 65 to 75? No, I don't usually do that, John. I don't get into gamma. The only time gamma is really important, I mean, it could be in that situation, but typically gamma is much more important on a stock that's, if you see a stock that opens in the morning and it's stacking these big green candles, the stock is ripping up, right? Like at a $50 stock that goes to 60, then 65, then to 70, right? The gamma is going to be very high here. It's going to change change the delta very quickly. And what you'll find is if you get in a stock, let's say the stock starts at 50, moves up to 60 and it's moving fast, and you buy the option at $60 option and the stock moves up to 70, the option might have, the price gone up $10 on the stock. The option price may actually go up $12 or $13 because the gamma is changing the rate of change in delta. So you could actually have an option moving up faster than the stock price. Okay, now this is a double-edged sword, because if you catch something like that, you got to know when to get out, because once the stock levels off and starts to move sideways, okay, the gamma drops fast. The gamma is going to drop way down. So what happens is, if you have a stock that you bought, let's say you bought the option at $10 and the stock goes up 15, and instead of having a $25 option, it goes up to 30. As soon as the stock starts to move sideways, the gamma is coming out of the delta. So what happens is, as the stock starts to momentum wanes and the stock moves sideways, the option price starts to go down, even though the stock is not coming down. You say at the same stock price for half an hour, you've drained out a lot of premium out of your option, and you're looking at this option and can't understand why is the option price going down when the stock hasn't moved down. That's why. It's the gamma. Okay. The primary option strategies I use, obviously long calls and long puts. I do put credit spreads or call credit spreads to capture premium. I use put debit spreads or call debit spreads. These obviously are debits, and I use a spread to cut down the risk because it doesn't cost as much. I also will do that if I have a relatively close resistance level above, for example, on a call debit spread, where I don't think it's going to get above that. I can then sell a call above that to create the spread, and that call will go down in value, and I can actually make money off of the short call. I do calendar spreads, which I call time spreads. Time spreads is one of those calendar spreads. That's what I do. I don't do condors. These are neutral strategies where I don't do condors. I do some butterflies. I don't call them out in the room most of the time, but I do some butterflies occasionally. But I do strangles and straddles, but strangles mostly in the room. I don't alert on these because they're too quick. It's a strategy that I've developed and have been developed for about 4 or 5 months right now, a specific kind of strategy that's working really, really well. But I'll do those. And straddles are similar to strangles. A strangle is if you have a stock that's 100, a strangle is you buy a $101 call and a $99 put. You buy one strike price above, one strike price below. It's called a strangle. If I did a straddle, if I had a stock at 100, I'd buy a $100 call and a $100 put. That's a straddle at the same price. All right, let's see. John says that's a 25. Yeah, when you're talking about the gamer and the stock moving up fast, yeah, it's a 25% instant gain. You probably take advantage of. Absolutely. That's the whole point. that's the whole point. Those momentum stocks. You got to be really, really good at trading those momentum stocks, because once the momentum wanes, if you're in the options, if you're trading the stock, it's okay. You're not going to be impacted by that, but you will be on the options. All right, so these are the bullish, bearish, and neutral option strategies. All right, this is a pretty interesting thing. So if you like a stock long and you want to trade an option, these are your options. You can do a long call. You can sell a put. You can do a short put. You can do a put credit spread or a call debit spread. All of these are valid bullish option strategies. Bearish option strategies is the opposite. Short calls. Never do this, by the way. Never do a short call. Don't sell calls naked. It's a good way to completely destroy your account and end up on a margin call. You can do long puts. This is a short strategy. Call credit spreads and put debit spreads. So those are the 4 that I use for option trades. Now, neutral option strategies. Condors I don't use. Straddles I do use, and time spreads I do use. Time spreads I do over earnings. So it's a neutral strategy. I don't care if when the earnings come out, I don't care if the stock goes up or goes down. I'm neutral on the direction. I'm not impacted by the direction. I'm impacted by how much it moves. All right. Time spreads, you don't want the stock to move too much. You don't want it to move more than what the expected move is expected to be. If they're expecting a 15% move in a stock after earnings, up or down, and it moves 10%, you make good money on a time spread. So this depends on the stock moving not an awful lot in either direction. Strangles, you want it to move a long way. You want a big move, strangles or straddles. You want a big move either way on these, up or down. You don't care which one. All right, so those are the strategies that list. It's a nice little list to have. If you look in bullish, you can say, okay, what's my best strategy here? All right, so these are the basic strategy setups, and I know this is taking a while, but I think it's something for people that are interested in options. I want to give them some good information here. So put credit spread. All right, you sell a put and buy a put at a lower strike price, and you receive a credit. If you're doing a put credit spread on Microsoft at 100, you sell a $100 put, you buy a $95 put, you get a credit. All right, a call credit spread. You sell a call and buy a call at a higher strike price, receive a credit. This is a bearish strategy. You don't expect the stock to go up. This is a bullish strategy. You don't expect the stock to go down. You don't expect the put that you sold to be for the price to drop below that. You're expecting it to stay above there. And the debit spreads, buy a put and sell a put at a lower strike price for a debit, and a call debit spread, which is bullish, buy a call and sell a call at a higher strike price for a debit. Those are the strategy setups that you use for those. The calendar spread is I use a call time spread. You sell a put or a call at a near expiration date, like this week's, and buy or call or put with a later expiration date for a debit. So a time spread, what I do for time spreads on earnings, a specific and calendar spread, I use the current week's expirations and next week's expiration. So I sell a current week's expiration, call or put, usually a call, and then I buy a next week's call or put at the same strike. This allows me, when the earnings come out, if I'm selling this week's expiration on the call, and the time decay comes out of that call, the volatility comes out, and I get volatility crush, then I'm capturing the difference between this week's volatility and next week's volatility on this week's call, and then I buy next week's call, and I can usually just sell them together and make a profit, because this week's volatility dropped faster than next week's, and this week's time decay went down faster than next week's, and the two together give me a time spread profit. And usually the profits on those, you're not typically I usually make 25 to 50% on time spread. And they can be losing time spreads if it goes beyond what they expect. Then you get into a situation where you got to do some modifications. Again, here's a strangle, buy a call and buy a put, one strike or more away from the money, at the money using the same expiration. Straddle, buy a call and a put at the same strike and the same expiration date. Okay, so those are the option strategy setups. All right, so choosing the best option. This is a little bit more subjective. The strike price I'm going to take typically is going to be in the money. Again, 65 to 75 delta. Expiration date, I have to take a look when earnings are going to be, but typically, even if I'm going to get out of the trade today, I'm going to go out 2 to 3 weeks in expiration, because if I can't get out today, I don't want to have a lot of time decay taking a toll on it. So the expiration date will be out. Now, if earnings are coming up fairly quickly, let's say 3 weeks out, I'll probably take an expiration date that expires after earnings. Now, follow me on this. I take an expiration date that expires after earnings. Two things happen. A, it's more expensive because there's a lot of premium built into that premium because earnings are coming out, right? But time decay doesn't impact that option as much as it would as an option that expired before earnings, because of the fact that volatility is built into it, and that's going to stay in there. So it's important, if you do this, however, if you buy a stock, an option that expires after earnings, that you get out before earnings. But what it does for you is it mitigates any kind of a loss on time decay because of the fact that there's so much premium built in there. You're going to pay more for it. And then the delta, 65 to 75 almost all the times. Sometimes what I do is I look at the option chain and I look at the expiration date, and I try to find the one that's got the tightest spread and the best intrinsic value for the option that I'm taking. So I'll look at 2 or 3 different expiration dates. I'll look at 2 or 3 different strikes. I'll try to get around 65 to 75. Maybe I have to go to 80 because the spread is tighter. And so there's a few things that go into it, which is why I say it's a little subjective. But that's how I find the best option. All right, let's see if we get any questions here. Are you selling naked calls as part of any of these spreads? Well, yeah, I sell naked calls, but keep in mind, okay, the definition of a naked call is a call that you've sold that you've got nothing else for that stock. You don't own the stock. If you own the stock and you sell a naked call, it's called a covered call. So you're not really selling a naked call. And if you're doing like a call debit spread where you buy a call and sell a higher price call, you're selling a naked call. You're selling a call, right? But it's not naked. Naked calls are only when it's not covered by part of a spread or you have a credit spread. Yeah, the call credit spread, correct. Yep, that's exactly right. All right, so that kind of covers the recap I wanted to do on options. I hope that helped some. What I want to do now is we talked about the Compass system. We talked about our strategies. I want to show you some recent trades and these high probability trade setups, why we took them and why and et cetera, just so you can see. All right, so this was one not too long ago. This was Lulu. We did this on 4/5. This was a put debit spread. All right, so I did a put debit spread. I did it overnight, and put debit spread. I get in for $1.92. This is a daily chart. Now let's look at the daily chart on Lulu here. Okay, so here's the end of the day right here. All right, you see it was earnings, and you see I let it play out. This was a put debit spread. I did it right here. Everything, you notice that everything is red or yellow. The Compass system tells me that the institutions are selling this trade. They're selling this Lulu. All right, so I took it overnight, and I entered for $1.92. I took a debit spread for $1.92, and I got out the next morning for $3. All right, it might actually have been a couple of days. I can't remember, but we had a nice debit spread that worked pretty nicely, and again, 56% gain on an overnight trade. And obviously, the institutions were selling this thing. You notice we get a little bit of color changes in here, but generally speaking, we still were bearish on the current time frame. This is a daily. And you get a few chops here because the stock's kind of compressing, but that isn't enough to concern me. Everything was red here when we took the trade. Actually, I think we took it right there. So yeah, I guess we took it right there as the stock compressed. Yeah, I have to refresh my memory, but we took it there. That's why I put the arrow. Compression, took the debit spread. Everything was yellow and red. Took it here and get out overnight. We went here, get out here. That little bit of a drop gave us a 56% gain. But I want you to see how the Compass system is telling me that the institutions are selling. All right, so this was Shake Shack, 2-day trade for 25% profit. Get in right here. This is, again, a daily chart. Can we tell if the institutions are buying or selling? Certainly can. Everything's green. Institutions are buying the heck out of this thing. All right, so I can get in right here, and I took for 2 days 26% profit. Not a very steep run up, but it was running, still running off the support here, and everything was green. So that was a pretty nice trade as well. Workday, 5-day trade for 30% profit. Here I get in. Actually, I get in right here on this blue. Now I had to watch this because the current time, multiple time frame went yellow, but we'd had so much down move that was turning this multiple time frame a little bearish. But the current time frame, notice, stayed blue the whole time and then went to green. So I took it here and wrote it up as it came out of. See this shaded area here. This is produced by the Compass system. This is what's called a dynamic compression zone. This tells me when the stock is in compression, and you can see when it breaks out of that compression, which is what it did right here. All right, and these, by the way, are Fibonacci candles, so I can spot the reversal. So anyway, that was a 5-day trade for 30% profit. And I just want to go over these charts so you can see what I'm looking for. Sometimes you got to go through a lot of stocks to find these setups. Dynamic compression zone. Everything blue or green. Institutions are buying. Another daily chart. Bought right here. You see how it compresses? And it popped out of it here. And we wrote it up. And 2 days. Boom, boom, and out for 26% profit. This was MDT. This is a medical device company. And 25% profit on a swing trade. Get in right here. Right here as it rode along this 15 EMA. And when the current time frame went blue from yellow right here, this tells me that the institutions were now selling it here, buying it here. They'd already been buying it long term. So this lined up with the green here and the blue here. Time to get in, you get in, we take it, and it rode up nicely. I get out 25% profit. I probably could have made more had I stayed in the trade a little bit longer. VKTX, Viking Therapeutics. Again, right here. Everything was green. We had this nice pop, very, very strong pop here, and took the trade here and just wrote it up here for 30% in 3 days. This was telling us the institutions were still in there buying. When the market gets choppy like this, you have to kind of take profits, and you can. It's kind of a subjective decision. This was an overnight trade on McDonald's. This was a daily chart. You see the pop out of the block. You see the compression zone here, the dynamic compression zone, the shaded area. You see the compression as the stock moves sideways. Here's another pop out of the box symbol. The institutions buying? Yes, they sure are. They're buying McDonald's. So we bought it here. We held it overnight. We get it at $8.30 for the option. I forget how far out we were in time, but and we sold it the next morning for $11.30, a $3 profit, 37% gain on that one pop right there. It's still bullish here, by the way, even though it's pulling back. But I'm not going to give up a 37% gain overnight like that. And again, it was this was in December when the market was getting a little choppy. Crowd, nice gain here in crowd. And you notice we get some color changes here, so we have to be aware of that. But the current time frame momentum, and this is a daily chart, so the current time frame was staying bullish the whole way. The multi-time frame was chopping around a little bit, so I know the institutions were kind of in and out a little bit on this. But I get in here on this blue because a lot of times I'll take it as it first turns blue, and then I just have to be aware if it's switching back and forth. But I stay in the trade because there was no reason for me to get out of here. The price action was working good. We took 20% profit on it. Amazon, this was a 5-minute chart right here. So Amazon, you can see it compressing here. Now we didn't have a multi-time frame trend green, but we had everything else green. And these are the most important ones to me. Multi-time frame momentum, current time frame momentum. This tells me what the momentum is. So I'm happy with that because the trend is yellow because we've had so much flatness here. And the multi-time frame trend was yellow. But see, this is the current time frame trend. See the green line? that tells me that it's bullish and it was sloping up. So I buy it right here in this pop out of the box as it gets above the 15 EMA on a 5-minute chart. And I ride this thing up for 45 minutes for a 32% profit. ENPH. So I don't want to beat these to death. I'm going to cut off some of these because but I just want you to see the selling. Is it bearish? Sure is. Pop out of the box symbol right here. Compression break, take it here, 20% in an hour. I do like to cover this Verizon one because this is an interesting one. Verizon is a pretty slow moving stock and the options are really cheap on it and tight spreads. So we get in here on this 5-minute chart here as it broke this compression break. You see the pink arrow, dynamic compression break. Institutions are selling. We bought it here and we paid 45 cents, $45 that is, for a option. I think it was out 2 weeks, 45 cents because it was in the money a little bit, but they're cheap. Verizon's not cheap. This is, we stayed in for 1 hour and we get out at $6.70. I'm 67 cents. So $450 of 10 contracts at $450 get you out in an hour at $670, 50% gain in an hour. These are really nice when you can catch these kind of moves on those low price stocks like that. All right, so this is a SPY super system setup for anybody interested in the SPY super system. This is where we get in right here on this pop out of the box. Market internals were telling me that the market was selling. The institutions are obviously selling the SPY. Look at the red here. I buy it here and I write it down here and I get out right here as it at the bottom of this. I got out here or here. I don't remember where exactly, but as it pulled down. Again, they're fairly quick trades, which is why I can't alert on these, but I can call them out of the room. Tesla, this was an overnight trade. Again, we take these overnight sometimes. This was a pop out of the box symbol on the daily chart, right? On the 5-minute chart from the previous day. See it right there? All right, see how everything is red or yellow? Take Tesla overnight. We get a break. Sometimes you get lucky. The stock dropped from 120 to 112. Options exploded. Options went up $7.50 on each option contract that we had. Sometimes you can get in these and they won't drop the next day, and you kind of have to manage them from there. But that was a nice one right there. All right, so that kind of covers all the things I wanted to cover today. John, let me ask this question here. I've got a couple here. Please show us how you alerted to these trades. You mean how I sent the alert out, Chris? You're talking about? I mean, when I spot it, all right, when I spot the setup. Now, if it's on a daily chart, it's much easier because a lot of times they can be swing trades. So when you're getting in the swing trade, the entry is not that critical. On an intraday trade, then I have to catch it pretty quickly. And usually I'm looking for them, and as soon as it gets there, then I go ahead and call it out in the room, put the alert out, and then take the trade. John, what constitutes the compression that produces the maroon colored rectangles below the candlesticks? Some of the examples, maroon colored rectangles. Let me go back and look here. Right here, you're talking about. Yeah, this is a pop out of the box to the upside. That's a bullish pop out of the box. Now you're not going to be taking it. Obviously, the stock's bearish, so you're not going to be touching this. You would not take a stock long here. And this, by the way, is the VWAP, the volume weighted average price right here, the pink line. So you're only going to be trading short below the pink line and long above the pink line. But this is a bullish pop out of the box, a bearish pop out of the box, and this is a bullish pop out of the box. This is one you'd be considering taking puts on, and this is the one you'd be looking taking calls on, but not with this setup. But that's what those arrows mean. Earlier example. Let me see if I can find it. There are only so many charts you can look at one time. Do I use a scanner? Yeah, I'll show Chris. I've got several scanners. Let me see which I'm not sure, John. I'm not sure what you mean. You called it the maroon, not red colored rectangles. Not sure what you mean, John. Crowd, okay, let me go back to crowd, okay. Sorry for this, but okay, crowd, colored rectangles. All right, so this is what you're looking at, maroon rectangle. Not sure, I mean, the only thing I see here is maroon. You see it on that chart? Big white arrow overlays it. Oh, this right here, this is a dynamic compression zone. The maroon and green, that's a dynamic compression zone. That's the Compass system creates. We have pop out of the boxes, which we use for compression zones, and Compass also looks for what's called dynamic compression zone, using some specific criteria to tell us when a zone is there. So if the stock stays in that dynamic compression zone, whether you're on a 5-minute chart or a daily chart, when it breaks above it, below it, it's a decent entry level. Okay. All right. So these are what we do. We went over those. This is the offers that we have today on the Compass Alert Service. Again, the Alert Service is $9.98 for a year if you use the Save 50 coupon. And by the way, the links are in the chat box for the links to the services that we provide. It comes with 1 month in my live trading room. If you take the alert service, you also get the Discord chat room, obviously the SMS alerts, and I also get about 25, 26 videos out there on all the strategies we use, how the Compass system is used, how you find high probability trade setups, what are Fibonacci candles and how to use them. So a lot of really good information on the videos. And again, if you want to try it for a quarter, $3.96. You just put in Save 200, or you can call Rory, 786-732-4656. All right, and this is the trading room itself. Trading room itself includes the alerts, right? The trading room includes the alerts, so you can be in the room getting the information from the room. Because again, we take some trades in the room that we don't alert on. You're in the room, you get the alerts, and you're in the room. Obviously, you get the Discord chat room, and you also get the videos, the training videos that we have. $11.98 for a year, pretty good. You saw the price, some of the profits we were taking in the room and also on the alert service. Try it for a month, $148. Not something I recommend. This doesn't give you enough time to really make a judgment, but some people do that. And then the last thing is the actual Compass system itself. We actually do sell the Compass system on an annual subscription. If you buy the Compass system, you get a month in the trading room with me. You'll also get the alerts for a month, and you get all the videos. And it comes with multiple scanners. I'll show you some of the scanners in just a second. But this is the Compass system for a year, $12.49, which concludes a month in the room. Or quarterly for $5.98. You can try it for $5.98 for a year. And it does come with my Workspace, so it's going to look exactly the same as my Compass system does. Let me just pop that up there again so you can see it. All right, so here's what it looks like. This is what my Workspace is. Here's some scanners over here. We have a bunch of different scanners. If you just click on the chart, by the way, right here, like Para, it's gonna bring up the chart. So you can just click from one chart to another on the scans. And I have several different scans. I won't go over all of them, but I've got quite a few scans. This is one that's looking for these pop out of the box symbols. I've got them for cascading up and cascading down. We have quite a few different scans, but that's what the Compass system looks like. This is what my Workspace looks like. If you buy the Compass system, you get this. Rightline will call you, and or you can call them, and they'll log in your machine and they'll put it on there for you. You don't have to worry about the technicals on it. They'll actually do the installation for you. All right. So that is the presentation. I probably took a little longer. Yeah, it took almost an hour and a half. I'm sorry, but I wanted to spend some time on options. I know a lot of folks do webinars, and again, like I said, I'm not a professional presenter. A lot of people like to do webinars, but I like to include some educational material, at least in some of the webinars I do. and because I think, you know, it's useful for people. So again, I hope that helped. So those are your special offers. The alert service, $9.98. The options room, $11.98. The Compass trading system itself, the actual software that runs on your ThinkorSwim platform, or Ninja. It also runs on Ninja, by the way. And by the way, if you've got it on Compass, if you get Compass on ThinkorSwim, you don't have to trade on ThinkorSwim. I don't trade on ThinkorSwim. I just have my Compass system installed on ThinkorSwim. All right. All right, I think we've got quite a few questions. John, thanks for all your questions. I appreciate it. I try to be as clear as I can on these, especially with options, but I appreciate that. So anyway, I think we've used up enough time for everybody. Listen, I really want to thank you for coming here on Saturday. I hope to see some folks in the room or in the alert service next week. Should you call or wait for a call? Either way, Rory will get you. He's probably got a lot of follow-up to do. But you can call him and leave a message. But if you put your name and number, and he's going to get that anyway. So, John, so he'll do that. Let me look here at the chat. Yeah, all the links are in the chat as well. So, and again, any questions? 786-732-4656. John, you can just call him and leave a message. He'll get back to you. He works pretty hard. He spends a lot of time. We have a lot of folks on the system, and so bear with him a bit. But he'll answer your questions, and he's going to be extremely accommodating for you. So everybody have a great weekend. Thanks for being here on Saturday. I appreciate that. I appreciate you taking time to out of your day to listen to me, and I hope the options training helped a little bit. Sandy, thank you very much. I'm glad you enjoyed the session. All right, thanks everybody, and look forward to seeing you in the room and or alert service. Come on the first of the week. Have a great weekend.